Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about LINDSAY Corporation quarterly report. LINDSAY Corporation offers a diverse range of businesses and services through its two main segments, irrigation and infrastructure. The irrigation segment provides various products and services, including center pivot irrigation systems, lateral move irrigation systems, and chemical injection systems under the Zematic brand. The company also offers hose reel travelers, variable rate irrigation systems, flow meters, weather stations, soil moisture sensors, and remote monitoring and control systems. Additionally, LINDSAY Corporation provides repair and replacement parts for its irrigation systems and controls, as well as custom electronic equipment and industrial Internet of Things technology solutions. The infrastructure segment focuses on road infrastructure products and services, including the road zipper system, which is used for highway reconstruction, paving, and resurfacing. This segment also offers redirective and non-redirective crash cushions, movable barriers to enhance highway safety, specialty barriers, perform tape and road safety accessory products, as well as rail products such as signals and lights, structures, foundations, junction boxes, and signs. Overall, LINDSAY Corporation's businesses and services cater to various industries, including agriculture, construction, and transportation. LINDSAY Corporation market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. LINDSAY Corporation trades at a lower price-to-earnings ratio of 19 times and a higher price-to-book ratio of 2.1 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 37% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified through a review of the extracted summaries. On the revenue decline side, infrastructure segment revenues have been significantly impacted, with a 58% decrease attributed to decreased infrastructure revenues on page 27 and a further 33% decrease due to similar reasons on page 29. The irrigation segment has also experienced declines, with a 5% drop in demand on page 24 and decreases of 6% in North America and 8% internationally on page 29. In contrast, while there are no explicit mentions of revenue growth, some segments have shown positive trends. For instance, the irrigation segment saw revenue increases of plus 4.5% and plus 3.8% for 3 and 6 months ended February 28, 2026, respectively, as mentioned on page 16. Additionally, a comparison between 2025 and 2026 irrigation segment revenues reveals growth of $2,761, from $23,283 to $26,044, as noted on page 22. These findings suggest that revenue growth is possible in certain segments, but infrastructure segment declines remain a significant concern. The net income and profit margins of the company have experienced a significant decline over the past year. In Q2 2026, net income decreased by 54.4% to $12,045 compared to $26,576 in the same period last year. This trend continued into HON 2026, where net income dropped by 34.7% to $28,569. The decline in profit margins is also evident. The gross profit margin decreased from 33.4% in Q2 2026 to 26.8%, while the operating income margin plummeted from 17.2% to 8.3%. This downward trend was observed across all periods, including HONE 2026 and the 3 months ended February 28, 2026. The reasons behind this decline are multifaceted. Lower revenues in the irrigation and infrastructure segments have contributed significantly to the decrease in net income and profit margins. Additionally, a higher proportion of international irrigation project revenue has diluted the gross margin. Furthermore, an unfavorable impact on gross margin from a non-repeating $20 million project has also played a role. Finally, an increase in selling and R&D expenses has further exacerbated the decline in profit margins. The company's financial performance is a testament to its ability to generate positive operating cash flow. A review of the operating cash flow data reveals that the company has consistently produced positive results. In fact, the most recent figure for February 28, 2026 stands at $123,111, indicating a strong trend. Furthermore, a comparison with previous years shows an increase in operating cash flow. For instance, the August 31, 2025 figure of $142,027 is higher than the preceding year's result. This upward trajectory suggests that the company's financial management strategies are yielding positive outcomes. Additionally, the net cash provided by operating activities also supports this conclusion. The figures for February 28, 2026, as reported on pages 15 and 31, stand at $23,966 million and $24 million respectively. These results demonstrate that the company is generating sufficient cash from its core operations to meet its financial obligations and invest in growth initiatives. Overall, these indicators confirm that the company is indeed producing positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt, the current portion of long-term debt has decreased by $83 million, from $231 million to $148 million. However, the total long-term debt remains relatively stable at around $114 billion. In contrast, the company's interest expenses have increased significantly. The translation losses/gains reported for the 3 and 6 months ended February 28, 2026 show a loss of $2.7 million and $1.4 million respectively, compared to gains of $2.6 million and $4.6 million in the same periods last year. Furthermore, the interest income and expense have increased by favorable changes, from $2.2 million to $4.8 million. Additionally, foreign currency losses have increased from gains, with a loss of $1.5 million compared to a gain of $0.3 million. The cash flows used in financing activities have also increased significantly, from $9.8 million to $63.4 million. Overall, the company's debt level has decreased slightly, but its interest expenses and foreign currency losses have increased significantly over the past year. The company's financial performance varied across different segments and regions. In terms of poor performance, the infrastructure segment was a major concern, with revenues decreasing by as much as 91% in some areas. The North America irrigation segment also struggled, with revenue declines of 8% and 6%. International irrigation segment saw minor decreases in revenue, but Brazil's limited available credit and elevated interest rates led to lower sales volumes. The irrigation segment as a whole experienced a 5% decline in revenues, accompanied by a decrease in gross profit. However, not all segments were affected equally. The MENA region in the international markets performed well due to large project sales, generating significant revenue. Additionally, road safety products showed good performance with higher sales. These pockets of success suggest that the company has opportunities for growth and improvement in specific areas. Management is optimistic about the company's outlook and strategy. They plan to continue investing in revenue and earnings growth, which will be achieved through various means. The top priorities for using cash include investing in organic growth, such as expanding into international markets and making capital expenditures. Additionally, the company aims to make synergistic acquisitions that provide attractive returns to shareholders. Management has also outlined specific plans for using cash, including increasing dividends over time and engaging in opportunistic share repurchases. Furthermore, they have provided a clear target for capital expenditures, with a range of $50 million to $55 million expected for fiscal 2026. This demonstrates the company's commitment to investing in its future growth, while also returning value to shareholders through dividend payments and share buybacks. The company's financial performance is reflected in its dividend payment and share buyback activities. Notably, the company has a history of paying dividends to its shareholders, as evident from the records on page 15 for both the 6 months ended February 28, 2026 and 2025. This demonstrates a commitment to returning value to investors through regular distributions. In addition to dividend payments, the company has also engaged in share buybacks. Specifically, during the current year, the company repurchased $55.5 million of common shares, page 31. This strategic move aims to reduce the outstanding share count and potentially boost earnings per share for existing shareholders. Concerns about inventory buildup and supply chain disruption are evident in recent data. The value of inventory has decreased by $10 million, indicating a potential issue with inventory management. However, the increase in finished goods and purchased parts suggests that there may be some stockpiling or accumulation of inventory. Furthermore, there are concerns about supply chain disruptions due to tariffs imposed on imports from various countries, including Canada, Mexico, China, and others. The company is also considering the potential impact of additional tariffs or retaliatory actions, which could exacerbate the situation. Additionally, freight and other input costs have increased in the short term, further complicating the supply chain. That concludes the financial summary for Lindsay Corporation. Feel free to comment below, and I will be happy to answer them when possible.